Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my good friend Adrian Day, the founder of Adrian Day Asset Management. Welcome back, sir.
Well, thank you, Ivan, for having me.
Yeah, absolutely. Always a huge pleasure having you come down to Wall Street Silver. Such an interesting time in the world right now. I wanted to focus on gold, silver, but let's start off with the U.S. economy, the U.S. dollar. They're starting to reduce the interest rates. Where do you see the U.S. dollar going now now for the next year or two and interest rates?
I think on balance, certainly over a 2-year period, we're going to see a lower dollar, and that's for a lot of reasons. The U.S. If you looked at the U.S. in isolation, which of course doesn't make sense, but if you looked
Right.
at the U.S. in isolation, with twin deficits, large budget deficit and a large trade deficit, twin deficits have traditionally been weak for economies, a slowing economy, lower interest rates. All of
Right.
those things would point towards a lower dollar. Now, what of course has kept the dollar high over the last 5, 10, 20 years, despite the twin deficits that are large and have been growing, is the fact that the dollar is the world's reserve currency. But as we know, it is slowly, inevitably, it is losing that position. And so
Right.
when you combine the economic position together with a continuation of a reduction in the status of the world's reserve currency, I think you're looking at a lower dollar, certainly on a 2-year basis.
Yeah, absolutely. And where do you see your outlook right now for, the whole general precious metals market, gold, silver? There's been so much excitement right now for gold in the past 6, 7 months. Even silver, we're recording this on the 7th of October, but, just the past couple of days, we're seeing some volatility in silver. So can you speak on the precious metals market side?
Yeah, sure. Certainly from a longer term point of view, I couldn't be more bullish on both gold and silver than I am right now. And we can talk about that part of it if you want, because I think it's important to put it in a context.
Right.
Certainly the last few days have been kind of weak for gold since last Friday, really, for gold, for silver, and for the mining stocks. Um, 10 days ago, I said I was looking for a pullback, but not for the reasons that it came. So I don't get any kudos. Look, anytime you see a thing run up the way it's just run up, and you look at a graph of maybe the last 3 years, well, the last 6 months have been, or the last 2 months has been kind of exponential, or almost. And you just can't expect that to continue without, at the very minimum, a pause, if not a pullback. That's number one. Number two, of course, is the Fed rate cut, but spiked the latest rally.
Monetary Metals is offering 12% on silver, paid in silver in a historic offering. The first silver bond in over 150 years.
There's about $15 trillion worth of precious metals in the world, all sitting there. It's just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's not easy to ship, and it costs money to store in a protected manner. This platform allows gold to be put to productive use, so instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver, paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
In anticipation of and when it happened, well, that's now in the rearview mirror. So that's behind us. And so now the market's looking ahead to what's next. And the jobs numbers on Friday, the jobs report, US jobs report on Friday would suggest that the Fed may be a little slower at cutting rates, certainly than the market is anticipating. I think the market, frankly, I'm not saying the market's expectations are impossible, but I think they're certainly optimistic. I think another 2 rate cuts this year and then 3% a year from now. I'm not saying that's impossible, but that's certainly optimistic, which means that you've got the possibility or the risk of things not going the way you expect. So a jobs report, if the inflation numbers this week come in low, that's one more factor that will weigh on gold and silver in the near term. Remember, as I've said many times, and it's important for people to realize, when you're an investor, either you're investing your own money or a money manager, predictions are fun. That's what we all do. We make predictions, but predictions really aren't the essence of investing.
Right.
It's looking at risk, reward, and probability. And if the market is already overwhelmingly on one side, you may agree with that side, but if the market is not giving any credence to the opposite side, then your risk reward is completely skewed. And so you've always got to look at risk reward probability. So I guess what I'm saying is, yes, I think the Fed's going to continue to cut rates over the next 12 months. Little doubt in my mind about that, but maybe the market's being a little optimistic. So in the short term, I think we could get a bit of a pullback from gold and silver. But that's only short term, frankly. And the resilience that gold has exhibited over the last 6 months, and but particularly just over the last several weeks, the resilience is really quite astonishing. So, when China stopped buying gold, you hardly got a blip in the market. China National Bank, the People's Bank, stopped buying gold. You hardly got a blip. We've been 4 months now without China buying. China was the number one buyer. We've had 4 months now without them buying at all. And, the market's hardly stopped moving up.
Wow.
Which is a very, very strong sign of a disbursement in buying and a very deep market. So I don't expect a deep correction. It may not even be a correction. It may just be a kind of pause for a week or 10 days.
Yeah, it's getting crazy because everything that's happening in the world geopolitically, and you're seeing more craziness pop up all around the US dollar, the debt bubble. Like, can you speak on, Adrian, the debt servicing? Like, there's people are saying the debt servicing is going to be so astounding in the next year or two that that alone will just really hurt the US dollar and the whole economy.
No, sure, absolutely. And in my mind, that's the number one reason that the Fed has to cut rates.
Right.
Everybody focuses on how the economy's doing. Well, the economy's doing well, so the Fed doesn't have to cut rates. The inflation's up, so the Fed shouldn't cut rates. But there's not so much discussion about the other part of that picture, which is the federal budget deficit.
Yeah.
I mean, I think the Fed simply has to cut rates because of the U.S. fiscal condition. And, the economy, frankly, is what gives them the excuse to do it.
Right.
Or makes them hold back from doing it. But the reason to do it is not the economy. The reason to do it is the fiscal issue, no question. And, as we've discussed before, the main buyers of US debt, you've got an increased supply of US debt, but the main buyers of US debt are simply no longer buying, and in many cases are increasingly selling. So, I mean, Russia obviously isn't buying anymore. They've sold all they have, but China's the number one, and their percentage of their reserves in dollars has dropped significantly in the last few years, of a bigger pie, of course,
Right.
but a much smaller percentage. But they're not buying, and they are increasingly selling. Japan has still been buying, but as they increase rates even incrementally, and the dollar moves up even the yen moves up even modestly,
Right.
then at the margin, that's going to be an incentive for Japanese institutions to bring their money back from Europe and the United States and invest in domestic bonds. Obviously, a Japanese bond at 0.5% doesn't compete with a US bond, but everything happens at the margin, right?
Yeah,
And
absolutely.
so as the rates move up in Japan, then incrementally, more Japanese institutions will bring their money back. Because of course, if you're a Japanese institution, a pension fund, an insurer whose liabilities are entirely in yen,
Right.
if you move offshore to buy a foreign bond, even that of a safe jurisdiction with a high yield like the United States, you are still taking a major risk on your liabilities, because all of your liabilities are in yen. So they would much rather a lower return in yen than a higher return in something else.
Right.
So anyway, try to get back to the question, sorry. So incrementally, Japan is going to be buying less. And then you look at who are the major buyers, who are the major foreign buyers? Well, it's Cayman. It's the UK, Belgium, and Cayman.
Right.
In the UK, there is some real buying, like from pension companies and asset management managers and so on. But in Belgium isn't the second highest foreign buyer of US bonds, because all the Belgian dentists are buying US treasuries. That's hedge funds in Europe. And
Right.
Cayman, again, I won't draw the analogy, but that's hedge funds as well.
Right.
Now, hedge funds will buy treasuries, of course they will, but at a price, at a price. So I think we're going to be in a position where rates at the long end simply have to move up, and I mean 10 years and longer, simply have to move up to attract buyers.
Yeah.
Whereas at the short end, 5%, 4.75%, 4.5%, there's a lot of investors who'll buy a 1 and 3 month or 3 month T-bill and get 3.5 or 4.5% and be happy with it. So I think rates will move down at the short end, but up at the long end.
Yeah, absolutely. Now, what would you say, Adrian, to let's say, as the economy is really starting to heat up and people's dollars are starting to depreciate faster and faster, what would you say to that new investor, let's say looking at Adrian Day Asset Management, or or even just looking at silver and gold? What would you say to them getting into this market?
Well, clearly, I mean, a new investor, if you're concerned about the purchasing power of your money, which you should be, I mean, the number one thing you want to put your money into is you want to put your money in places that's going to protect that purchasing power. And the number one place that's going to protect purchasing power, obviously, is gold and
Right.
silver, the monetary assets. I think beyond the physical, beyond having a core holding in the physical, which I regard as savings. I don't regard it as an investment. I regard it as like having insurance and having savings.
Right.
The gold stocks are still, and I think it's important to emphasize this point, despite the fact that the gold stocks have gone up by over 50% since gold bottomed 2 years ago. If you go back to October of 2022, I guess you could call that a bottom. There have been several bottoms along the way, but that was the last, that's the bottom that we haven't gone below since
Right.
then. So if that's the bottom of the gold market, gold has gone up 57%. Gold stocks have gone up about 53% since then. So that's nothing to sneeze at, right?
Yeah, that's lots.
But the point that's really important, and I really want to emphasize, or several points, but the main point I want to emphasize is, gold stocks have gone up 53% in those 2 years, while gold has gone up 57%. You can look at 1 year, you can look at year to date, you can look at the last 6 months, and whichever time frame you want to look at, although the gold stocks have done well, they haven't exhibited the leverage, nor has silver yet, the
Right.
leverage over gold bullion. And that's important. I don't know if, I've got a chart up here. I guess I can't share graphs, can I? But I've looked back at last bull markets for gold, last markets for when gold took off.
Uh-huh.
And if you look at the absolute bottom of gold, that's the starting point. Whenever gold bottomed, And I've looked at like 1986. In the first 12 months, gold was up 6.3%. The XAU was up 82%.
Yeah.
In 2001, gold was up 12% in the first 3 months. Gold stocks were up 43%. So you can see, and we could go through every single period if you want. And so normally at the beginning of a bull market, gold stocks exhibit tremendous leverage. We haven't exhibited that leverage yet. And there are logical reasons for that. We shouldn't get upset. A lot of people say, why are the gold stocks lagging? But there's logical reasons for that. If you look at who was buying gold for the last 2 years, and particularly the last 12 months, and why they were buying, it was nothing at all to do with the macroeconomic environment. But that's beginning to change with the Fed cutting rates, with the economy clearly slowing, and the Fed cutting rates before inflation is really under control, the dollar dropping. All of these things are changing the macroeconomic environment to where it's favorable for the monetary metals. So I think we're going to see that leverage over the next 6-12 months. We're going to see that leverage exhibit itself. And even though the gold stocks are up, as I say, over 50% since in the last 2 years, you can look at companies like Agnico that is selling within the lowest 10 percentile of this historic price to cash flow ratio. You look at Barrick that is trading within 10% of its lowest price to net asset value. When I say it's lowest, I'm talking about over 40 years.
Yeah.
Now, when gold is at all-time highs, and when the outlook to me looks reasonably strong, these stocks should be having multiple expansion. They shouldn't be trading at close to their lowest ever multiples.
Yeah, they need to be trading. They need to be trading right where they need to be.
Yeah, and so I think the gold stocks remain cheap. The sentiment, despite the fact that the gold stocks have gone up 50%, the sentiment is still not in any way overwhelmingly bullish towards gold stocks.
No, not yet, but hopefully in the future.
That's British understatement. And so you've got a weak sentiment, you've got cheap stocks, undervalued stocks, and you've got all-time highs for gold. Now, one more thing, if I may, Ivan.
Yeah, of course.
You look at the last quarter, the third quarter, gold probably averaged, I'm just eyeballing it because I don't know the number, but gold in the third quarter probably averaged about $180 an ounce higher than it averaged in the second quarter. And the price of oil was significantly lower in the third quarter than the second quarter. Remember, oil spike has been since the end of the third quarter.
Right.
That means that the cash flows for companies, when they report, and they start reporting at the end of this month, the cash flows that companies report should be very, very strong. If we have 3 quarters of back-to-back strong and increasing cash flows,
right,
I've got to think that generalist investors are going to start looking at it. I mean, the gold sector has the highest growth in cash flow this year of any sector.
Wow.
And people tend to forget. I'm sure even a lot of your listeners, it'll hit you. If I say that both gold and the gold stocks have outperformed the S&P for the last 1 year and for the last 2 years, gold, of course, has outperformed since 1999. Gold has outperformed the S&P this century. Most people don't seem to realize that.
No.
And again, the gold stocks for 5 years, for 3 years, for 2 years, for 3 years, for 2 years, for 1 year, the gold stocks have outperformed the S&P.
Right.
And it's a stealth rally, but it's just not getting the attention it should get.
Wow. Yeah, it's interesting times we're living in, Adrian, and I think over the next few years you're going to start seeing that realization. So that will be massive. But such a huge pleasure you coming down to Wall Street Silver. Such a it's always great. I'll put your links in the description below so people can connect with you. And then I'd absolutely love to have you back on in the future, sir.
Well, I really appreciate it. Thank
Yeah,
you.
of course. Yeah, yeah. Talk to you soon. And again, everyone, thank you for watching, and hit the like button. Yeah, and then yeah, thank you so much, Adrian. Talk to you soon.
Thank you.
Bye.
Bye.